Hey, welcome to this week's Mortgage Minute with Mitch. So we're going to start out with some great news. The Browns absolutely handled the Steelers last night. Don't look now, they're currently in sole possession of first place, at least for the next couple days. We needed it after a tough loss against the Jets last weekend. We're not going to talk about that, but way to rebound, come back, and get that win. The Guardians, amazing, just got done sweeping the White Sox. So after just pretty much taking the Twins out of contention, went in, took care of business against the White Sox, currently sits 7 games in first place. So kudos to the Guardians. Let's hope we can kind of finish out the season strong. So on to mortgage news, unfortunately not looking great. This week the Federal Reserve came out, raised interest rates another 3/4 of a point, the third consecutive meeting that they've done that. And this one was a little bit different. It hit a little bit harder. And the reason being is, they're really aggressive in fighting inflation. That's been their messaging, that's been their goal. And the fact that this is the third time in a row they had to get this aggressive, it's starting to make investors lose a little bit of confidence in their ability to taper this kind of runaway inflation. Not only that, next week the final GDP numbers are going to come out for second quarter. They're not looking very good. It looks like they will be negative, so 2 consecutive quarters officially in negative GDP territory translates to a recession. So if that holds true and next week those numbers come out negative, I mean, there's going to be no hiding it. That looks like where we're heading. Even Fannie Mae thinks that by first quarter of 2023 we will officially be in a recession. They're revising numbers like crazy. Looks like unemployment's expected to go up next year. So I don't mean to be all doom and gloom, but that's where the market is heading. And unfortunately, interest rates this week have gone up. If you look at, you zoom out and look at the last 12 months, you can see where things have been heading. Now, we do have a cure for that, at least for the short term. And as the market kind of shifts, and we are starting to see signs that we're getting out of a seller's market, if you are listing a home, you're going to want to understand your options and look at ways to differentiate your listing from everyone else out there. So we have a perfect program called the Temporary 2-1 Buy Down. Now, it's kind of an oldie but a goodie. This isn't something brand new, but what it does is it allows a buyer to get a rate for the first year 2% below current market pricing. Then after 12 months, they're 1% below. And then after 2 years, then they just go to where the current market pricing is. So that's an incredible way to provide value to a potential buyer and help kind of soften the blow, because we've all seen interest rates continue to rise. And anybody looking to buy a home, it's not great to see. So this allows them to have a below market interest rate the first couple of years of the mortgage. Now, the great news too is a lot of experts expect the market to correct itself within the next couple of years. So if we do see rates take another dip, we can always look to refinance, get them back below current market pricing. And if that doesn't happen and rates continue to go up, well, hey, at least they're locked in. And worst case, they'd be locked in where they are today, not where they are down the road. So that's a huge advantage. And if you are thinking of listing a home, it's definitely a conversation worth having. You can pay for it as the seller, so the buyer would not have to pay for that cost. So great way, again, to differentiate your listing and help get your home sold. So if you have any questions, let me know. Would love to have the conversation with you, see what I can do to help and provide value. So thanks for watching. We'll see you next week.